Friday, the S&P 500 suffered its worst day drop since January. And if you saw your portfolio drop as well, you're not alone. So why did this happen and what's next? What should we do about it? Let's explore this in this video. So the media loves to scare retail investors. They like to create a lot of drama. So they said that the S&P suffered its worst day since January. And whenever you see the word worst day and you see a very sad face, usually it means that the market's close to the bottom. But I don't think his face is sad enough. So I'm not going to call the bottom just yet. But sure enough, Friday was a pretty big sell-off and the selling was indiscriminate. Basically, everything went down. Good companies, bad companies, they all went down together. So this is very much panic selling as well as program trading by algo trading machines as well as manipulation by market makers. That's why you see everything going down regardless of the fundamentals of the business. Now, if you take a look, you can see that the sell-off was the biggest among consumer cyclical stocks, which are consumer discretionary stocks, as well as technology, basic materials, healthcare, and financials. Now, most of the stocks I own are actually in technology and consumer discretionary. So sure, my portfolio had a pretty big drawdown on Friday as well. So if you take a look at the S&P 500 components, basically everything was red except Apple, right? And the only reason Apple went up is because Apple has been underperforming so much already that probably it's like, okay, we can't go much lower, let's just go up. And also because they came up with some news that they're going to be putting in a lot of AI chips into their new MacBook. So that gave a bit of a pop to the stock, which I was not too happy about because I had a lot of buy orders ready at 165 and 160 to buy Apple, and the darn price went up before I could buy it. So never mind, it may come down again. So people like to ask this question. Number one, why did the market drop? Why? And what should I do? So to answer the first question, why did the market drop? Well, if you read the media, the main reason that they give is because inflation came in hotter than expected. So because of that, the Fed may not cut interest rates as much anymore, or they may not cut at all. So initially, the market was expecting the Fed to cut rates in June, and now they say no, not June, and then maybe now in September, no, and now they've pushed back the rate cuts to November. So because of that, the 10-year Treasury yield long-term interest rates have also been rising. So that's one thing that the market is blaming for the sell-off. But they're also blaming the fact that the war in the Middle East is escalating, that on Friday they said that Iran would likely strike Israel, which they did, by the way, a few hours ago. The news came out that Iran has had a drone strike against Israel. So this is the reason the market goes down. But always remember that, are all these reasons important to read? No, they are not. Because I'm here to tell you that the market will always find a reason, will always find an excuse to sell off. And it's just a convenient excuse, because if the market did not drop because of this, it'll drop because of something else, right? Because remember that even in a bull market, and we are in a very strong bull market, the price can't go up in a straight line. It has to go through ups and downs, wave up, wave down, wave up, wave down. And so far in the first quarter of the year, we have this wave up. We have to have a wave down. So the market is just finding a reason to wave down, and this is a very good reason. Now, we did expect a pullback and a correction sometime in February or even March, but it didn't happen. So, maybe now it's time for that pullback and correction. By the way, if you take a look at all past election years in the US, this is a seasonality chart of what tends to happen on an election year such as this. So the market tends to be seasonally weaker in the month of April. In fact, it's kind of like flat in April, and pretty bearish in May, and then very bullish in June, July, August, and then weak again in September, October, and then it caps off the rest of the year very bullish in November and December, regardless of who wins the election. Like I said, don't be too hung up about, why did the market go down? The market has to go down. It's the nature of the market. It's like saying, why when I sit on a plane, there's going to be turbulence? There'll always be turbulence. Why is it in a marriage, my wife or my husband will always, get into a bad mood once in a while? It's part of the journey. And again, remember, historically, the market will drop 5% or more about roughly 3 times in a year. And so far this year, it has not dropped even 5%. So it's due, all right? And on average, about once a year, the market will drop at least 10%. And once every 3 years, it will drop 15% or more. Now, personally, to me, I don't think that we're going to get this year, but I do think we'll get at least a 10% correction or pullback at least once this year. So remember that these pullbacks and corrections are perfectly normal, they're perfectly healthy in a bull market, and the market's like a roller coaster. Enjoy the ride, right? The ups and downs. And the only people who get hurt on a roller coaster are those that jump off the ride halfway. So don't jump off, stay in the ride and scream on the way up and on the way down, and you will reach the final, I shouldn't use the word final destination, doesn't sound very good, right? But reach the high point by the end of the year. Now, like I said, fundamentally, I think that the economy and the markets are very, very strong, and I don't see a structural reason to be bearish, right? So again, the argument is that the long-term interest rate, the 10-year treasury yield, has recently been accelerating back higher. And the main reason for this is because the economy is stronger than expected. We just had payroll growth showing that over 300,000 jobs were created in the US, way above expectation. And of course, CPI came in a bit hot. So this causes people to sell off bonds. And by selling off the bonds, the bond yield goes up. So is this bearish for the markets? Well, historically, no. If the 10-year yield goes up because of a strong economy, that's bullish. But if it goes up because of tightening financial conditions, that's bearish. But we know that the Fed has actually been loosening financial conditions, and with stronger economic growth and the 10-year goes up, that's actually fine and bullish for the markets. In fact, historically, if you take a look at this chart, this is from Fundstrat, Bloomberg, which I've showed you this chart before. You can see that historically, when the 10-year treasury yield is between 3.5% to 5.5%, okay, you can see that historically the PE ratio of the S&P 500 is actually at the peak or at the highest point, right? And right now, the 10-year treasury yield is at 4.5%, which means that we are in that sweet spot where the market tends to have the higher valuations. So that is not really a reason for valuation multiples to contract because of the 10-year reverting higher. Now, how about the fear that what if the Fed doesn't cut rates? Again, there are two schools of thoughts. There are some people who think that, the moment Fed cuts rates, the market will crash. And some people think when the Fed doesn't cut rates, then the market is going to crash, right? But again, historically, if you look at the actual data, you find that rate hikes and rate cuts alone do not determine market direction, all right? In fact, there were many instances in the past when the first rate cut, when the Fed cut rates, the market crashed. This happened in 2019, 2008, 2001, and 1981. But there were also many instances, an equal number of times, when after the Fed cut rates, the market actually rallied very strongly in 1980, 84, 89, and 1995. So it's not the rate cut or the lack of rate cuts that affects the market direction. It's actually the strength of the economy, but more importantly, the strength of the earnings of the companies that are in the market. And we just had JP Morgan and Citigroup announcing better than expected earnings. So earnings are still coming in strong, and I do expect earnings to continue to grow this year. Now, for the rest of the year, at the beginning of the year, I said I'm bullish this year, and I do expect that the year will end double digits, and I still believe that there's a high probability that we're going to get there, especially after a strong first quarter of the year. So the first 3 months of the year, the market is up 10.2%, which is considered a very strong first quarter. Now, historically, a strong first quarter tends to translate to a strong full year in the markets. This research is done by Fundstrat as well. Credit to Fundstrat. Over the last 75 years, you can see that there were 38 years when the S&P 500 gained more than 2% in the first quarter. This is in the first column over here. All right. So these were all the instances when the first quarter return was more than 2%. So 2.2, 2.5, all the way to 21.6%. And when that happened, you can see out of the 38 instances, the rest of the year, which means from April to December, was positive 35 times out of 38 years over here, rest of the year. So there's a 92% chance that the rest of the year will be positive. And for the full year, which is over here, the full year, the S&P ended positive all the time except in 2011 when it was actually flat. But let's consider that as a negative year. Okay, so 37 times out of 38 times the market ended up positive. That's a 97% chance of probability, and the average gain for the year was 23%. So basically, in a nutshell, we have a 97% chance the market will be positive by the end of the year with an average gain of 23%. Again, is it a guarantee? Of course not. It's just a probability, all right? And you can see that in years where the first quarter return was 2% or less and negative, then the full year was a lot more bearish, right? So the first quarter is kind of like a harbinger of things to come for the rest of the year. Now, let's take a look at the technicals of the market. Of course, everyone wants to know, is this the bottom? Could we go lower? And of course, as always, the reality is no one knows. No one can predict the exact bottom of a pullback or a correction. I wish I could. I wish it could be done. It can't be done. All we can do is to guess potential support levels and potential reversal levels, but we will never know, all right? Now, so far, the market has retraced to its 50 moving average right there on the daily candles, and from the peak to where it declined to on Friday, it's about 3% decline. So like I said, on average, the market drops at least 5% 3 times a year. So sure, we could bounce off that 50-day moving average. We could, right? But don't be surprised that we could actually go lower. Number one, because the war has taken a turn for the worse, so there's a good reason for the market to sell off. And number two, it's only a 3% drop, right? So where could it drop further to if it's a bigger pullback or bigger correction? So if you take a look at the weekly candles, you can see I've identified 3 other levels of support based on the moving averages and based on the previous swing lows. So the next level of support I see for the S&P or the SPY will be 494. All right, and if it drops to 494, that would roughly be about a 5% drop, which is very, very normal, right? If it drops all the way to 479, that would roughly be about an 8% drop, which again is still very, very normal, right? And even if it drops all the way to this last support, which I think would be the strongest support, if it drops all the way down there, there'll be roughly about 12% drop, which again is normal in a bull market. Now, a lot of people like to ask me this question, Adam, what is the right thing to do if we are now going into a pullback or a bigger correction? Should I, sell everything and hopefully buy it back later? Should I just hold on to it? Should I buy more shares? What should I do? What's the right thing to do? And I think, the right thing to do really depends on, are you a trader or are you an investor? And I know some of you may have a trading portfolio, some of you may have an investing portfolio. And depending on whether you're trading or investing, the exit rules or entry rules are very, very different. So the whole point is to always follow your trading plan and investing plan and not buy and sell based on emotions or based on predictions, all right? So for example, from the perspective of a trader, if you're trading, whether you're trading stocks or options, then remember, in every trade, you gotta have a stop loss. And once it hits the stop loss, you just get out. Just get out and wait for the next trading signal. So for me, in my trading portfolio, I did have stocks that hit the stop loss recently. I just got out. And a good example would be Essentia. So Essentia is a stock which I entered as a short-term swing trade at this point of time over here. You can see when the price dropped and it hit the 200-day moving average, with a bullish pin bar. By the way, even if it's red, it's still a bullish pin bar if it's got a long tail and a small body. And this is a double bottom pattern. So it looked like it was going to bounce off. So actually I bought there, I entered there, and I put a stop loss right below the swing low. So initially it went up, but then it went down, and then on this day here, it hit the stop loss. I'm out, right? Just get out. So in trading, you just get out. And remember, in 100 trades, you'll have 50, 55 winning trades, 45, 50 losing trades. It's like that. But the whole point is when you lose 1 R, right? And when you take profit at 2 R. So that was my profit target. So if you lose 1 R for losing trade and win 2 R for winning trade, overall, you will make money. So when you get back into the markets as a trader, well, you have to wait for the next entry signal. And until then, you stay out of the markets. So for example, in the case of Essentia, I'll be watching the next support levels to see if there's another entry signal. So the next strong support level would be either here, over there, at about 301, or at 289, where it could potentially reverse. But of course, at that point of time, I'll wait for a bullish candlestick pattern, and ideally a double bottom pattern. And of course, looking at other indicators to help me to identify a high probability trade. Like looking at the volume, like Williams percentage R, MACD, and force index, and all that kind of stuff. So that is from the perspective of a trader. Now, from an investment perspective, it's a very different approach of what to do. Like the majority of my portfolio, as you guys know, is I'm invested in high quality companies that will continue to grow and multiply in value over the years. So in the short term, when you get these pullbacks or drawdowns or corrections, the right thing to do is nothing. Just stay invested. And of course, if you are still building a position and you got extra cash, that's the time you want to deploy and add more shares when the price reaches your predetermined buy levels. When they're undervalued and when they're at strong support levels, we add in tranches to average in our position. So a good example, once again, is Apple. If I can use Apple as an example, I don't have a full position in Apple and I want to add more and more shares in the position. And I think I've showed this before that my intrinsic value of Apple is about $168. That's my valuation. So now it's overvalued again, right? So I want to add more shares and my buy levels for Apple would be 165, 157, and 147. For the current shares I own, the average cost is 149, but that doesn't mean that I must buy more shares below my current average cost. I could always buy at a higher price as long as it's undervalued, right? So I'm patiently waiting for Apple to get to these levels before I start adding. Can I predict that it will go to those levels? Of course not. It may bounce up and, well, so be it. I'll then add more shares of my other high quality companies. Now, for most investors who are new to the markets and who get a bit emotional during these drops and they read all the bad news, or war is going to get worse and the market could correct more and the May looks like it's bearish. What's the instinct? The instinctive thing to do for most people is get out, right? Sell my stock, sell because it can get worse. And I avoid that crash and hopefully buy it back lower again. It's very tempting to do that. It's very tempting to want to sell where it is and buy back lower. And it's something I've mentioned I used to do in the past. But in the long run, I found that if you do that, yes, once in a while, if you sell, for example, here, and it goes lower, yeah, you feel very smart. And sure, once in a while, you may buy it back at a lower price and it goes up and you go, yes, But for every one time that happens, there'll be many times you will mistime it. And when you mistime it, this is what could happen as well. When, for example, it could be a stock or an ETF, you sell there hoping to buy it back lower. And the moment you sell for some reason, let's say the price goes back up and you go, shit, right? And you're out of the stock. And then you have to wait for another retracement to get back in. And the next retracement may drop, but not low enough where you got out. And it's psychologically very hard for you to pay a higher price. And next thing you know, it goes up and the stock leaves without you. And you are out of the markets. And in the long run, you end up underperforming the market. And this has also happened to me many times in the past, where I sell a stock, waiting to buy back lower, and sure enough, it goes lower, and I feel very smart. Yes, I made the right choice. I got out, right? But the problem is, where do you buy it back? Right? So let's say I think, okay, I'm going to buy it back here, all right? And then it goes down, and I'm going to buy it back. But before it reaches my buy, it jumps up. And I go, oh shit, right? It's starting to go up, but never mind. Wait for it to come back down again. I don't want to chase it. And it goes down. Yes, it's coming down. And then boom, it goes up. And again, it leaves without you. And again, back to my analogy, is like, if you're invested in a very good company, high quality company like Nvidia, like Meta, like Amazon, that's going to keep increasing over the years. It's like being married to a fantastic wife or husband. And when they're in a short-term bad mood, it's better in the long run to stay there with them through the good and bad times, right? That builds that long-term success. But if your wife is in a bad mood and you think, okay, let me get out and avoid her bad mood and I'll come back when she's in a good mood, once in a while that's going to work. But very often, you get out and by the time you get back, she's not there anymore. She's run off with the gardener or run off with your best friend. And that has happened to me many times on great companies. And through those lessons, I've learned that if I'm holding great companies that I know will go up over time, I don't want to try to get out and get back in. It's not worth the trouble. It's not worth the risk. I just stay invested. Now, of course, it's easier said than done, especially for people who are new in the markets. It's very easy to get very emotional. The moment prices come down and you see the value of your portfolio starts to drop, you get really upset, for people who are new to the markets. Well, just to show you my portfolio, on Friday alone, you can see, for example, I've got two portfolios. The first portfolio on Friday alone is down $72,000. My second portfolio is not that far off. The second portfolio is down $77,000, right? So what's important is you have to be able to look at your portfolio going through these ups and downs and be totally unemotional. There are a lot of people who get very emotional. Like when the market goes up and the portfolio increases in value, they're in a good mood. They hug the wife, they pet the dog, they kiss the kids, right? Then on days like that, they get upset. They kick the dog, they slap the kids, they give a black face to the wife, right? And they let the market affect them. So you got to be totally unemotional for this whole thing. Now, of course, don't cry for me, Argentina. You can see that although it's down in terms of dollars, looks a lot, but it's nothing, right? In fact, if you take a look at my account right here, you can see month to date, it's just down 1%, right? And year to date, it's still up 7.8%, right? And for the last 12 months from April last year to April now, it's still up about close to 32%, right? So 70% of investing is your psychology. It's remaining rational, it's remaining calm, and being emotionless. So let me share with you two tricks that I use to stay totally emotionless. Maybe even more than two tricks, right? Now, the first thing is to understand that the market price that you see in a short term has sometimes nothing to do with the value of the actual business you're owning. Remember, when you own a stock, you're owning part of the business. And as long as the business you own, the revenue is growing, the free cash flow is growing, the intrinsic value is growing, that's all you need to concern yourself about. Because in the short term, the market doesn't reflect the true value of the business. In the short term, the market is driven by manipulation, emotions, and news. So even if the market price drops 10, 20, 50%, to me, it doesn't matter because I'm looking at the value of the business. And people will say, I lost 140,000. I lost 10,000. No, you didn't. Unless you're forced to sell at that crazy price, you didn't lose shit. You didn't lose shit, right? Look at the value of the business. One of the things that I do psychologically that really helps me is that I never focus on the value of my portfolio today because I know that it keeps going up and down every single day. One day it can go up 200,000, one day down 100,000. It doesn't matter, right? But I see the value of my portfolio 5 years from now and 10 years from now. I see clearly where it's going to be, right? Now, I know that historically, my portfolio grows at about 20% growth a year on average. Again, on average, right? Like, for example, last year I was up 45%, but I can't be up 45% every year, right? Some years may be higher, some years may be lower. So I know it grows at about 20% on average at least, right? So right now, my two portfolios are together close to about $8 million. And I know that if it compounds at 20%, in 5 years, it's going to be about 20 million. In 10 years, it's going to be 50 million, right? So when I keep focusing on the 20 million in 5 years, 20 million in 5 years, 50 million in 10 years, I keep seeing that in my mind, and I know it's going to get there, then it doesn't bother you where it goes in the short term, right? So you got to think long term as an investor, and that is how you make rational decisions. I hope this was useful for you. If it was, do subscribe, right? And I'll see you guys in the next video. Meantime, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.